Hi viewers, in this video I'm going to show you how to prepare the income statement and statement of financial position of Papaya Limited. Right, let's draw the format first. So income statement of Papaya Limited for the year ended 31st of December 2008. Cost of sales, opening inventory, purchases, closing inventory, and then gross profit, then less expenses, and then income taxation and profit after tax or net profit. Okay, now I will draw the format of statement of financial position. Of Papaya Limited for the year ended 31st of December 2008. Starting with non-current assets. Then current assets. Equity and liabilities. We have capital. We have current liabilities. And then we have non-current liabilities. Over here I'll be calculating all the assets, and over here I'll be calculating capital plus the liabilities. Right in front of it I will have a space for workings. Right, now looking at the trial balance, ordinary shares 100,000, preference shares 50,000. So I've written those two. Then I'll be recording the retained earnings, which is 76,000. 76,015. 76,015. Next, I have intangible assets of 20,500. Next, I have land and building cost 450,000, accumulated depreciation 81,000. Land and building minus 81,000. So 81,000 is the accumulated depreciation. I will leave the bracket open because I will be calculating the depreciation charge for the year. Plant and machinery 82,000 and accumulated depreciation is 18,000. Plant and machinery. Inventory opening balance is 58,045. 58,045. Trade receivables 161,349. 61349 receivables. Cash at bank is 112,000. Revenue is 1,600,047. Purchases 907,989. Royalty income received. This is an income which we have received, and that should become part of my gross profit because it's an income. So I will be adding after the gross profit royalty. $39,045. So I've written into the second column because over here I'll be calculating my gross profit, and in that gross profit I will be adding the royalty income. Then I have administration expenses of 126,232. 26232. And then there is a distribution expense of 33,891. As you can see, I have left a gap because I know there will be some more addition into this administration and distribution expenses. Then we have factory wages, which will become part of cost of sales, 54,117. So you can see that I left some space, blank space, in case there will be any addition into the cost of sales, and we have found one, which is 54,117 wages. This must be the wages of staff involved in the production. And then we have administrative expenses, 24,824. Admin expenses, that was salary. Two 4,824. 4824. Trade payables 23,000. $10 bank loan note. Bank loan is 62,600. Next, we have final dividend paid, and that is 12,500. Notice that dividend will be paid out of the retained earnings. So you can see that I already have a retained earnings figure of 76,000. Out of that, I will have to subtract 12,500. So what I'm going to do is I can either show it as a separate working, or I can show it all in a bracket over here. I would prefer to do it as a separate working so that my format stays neat and tidy. So the dividend paid will be appearing on the debit side. The opening balance of retained earnings, which is 76,015, will be recorded on the credit side as a brought down balance. Now I have picked up all the figures from the trial balance. Moving on to the notes to the accounts. Depreciation is to be provided on the basis of the following policies. Building, straight line over 50 years. So the cost of building should be split over 50 years. Over here we have given in some information. The land originally cost £115,000. So what I need to do is, you can see that land and building cost is 450 already mentioned in the statement of financial position. In my workings, this is working number 1. Working number 2, depreciation. Land and building. The cost is 450,000 of land and building. Out of that, I need to subtract £115,000 because land is not depreciated. Building is depreciated, but not land. And the answer will be 335,000. I will divide that by 50 years. And the depreciation charge for the building will be £6,700. Going back to the note, this depreciation should be charged to the administration expenses. So you can see I already have an administration expense over here. What I'm going to do is, because I need some space to add some more expenses into it, I'll move it a little over here. Into that, I'm going to add 6,700. Next, the plant and machinery is to be depreciated over 10 years, and the depreciation should be charged to the cost of sales. Okay, so let's go to the depreciation calculation. This time we have building, and the value of the building is 82,000 divided by 10, and that will give me £8,200 as a depreciation for the year. That should be charged to cost of sales, and this has been charged to admin. So let's add that into the cost of sales, 8,200. Next is B. It says intangible assets is a brand. Following an impairment review, the recoverable amount has been estimated to be £12,000. The impairment should be charged to the administration expense. So we have an intangible asset, which is £20,500. We are told that the recoverable value of this intangible asset is 12,000 only. So that means there is an impairment. Number 3, impairment. 20,500, take away 12,000, and the impairment is £8,500. That should be charged to administration expense. By the way, I should have mentioned the notes. So the note for the depreciation is note number 2. I should write working number 2. Over here, working number 2. And this should also be charged to the depreciation should also be included in the statement of financial position. For the machinery, we calculated 8,200. For land, we calculated 6,700, and that is working number 2, and this is also working number 2. Now we can close the brackets. Moving on to the impairment. So the impairment is £8,500. £8,500. That needs to be subtracted from the intangible asset. Working number 3. And that should be charged to administration expense. So let's record it. 8,500. Working number 3. Impairment is actually a drop in the value of the asset, intangible assets. C. So we have done A and B. C is in 2008, preference dividend were declared on 31st of December 2008 and were paid on 15th of January 2009. So you can see that the preference dividend has been declared at the year end. At the year end. It does not matter when it was paid, as long as it has been declared at the year end. That means it is an expense for the year 2008. So from the question we can see that the preference dividends are 50,000 and these are 5%. Preference shares means they will get an interest of 5%. So 50,000 multiplied by 5% is £2,500. Again, that dividend will also go out of the retained earnings. So let's record it over here. 2,500 preference dividend. £2,500. Next. D. The tax of 22,500 is to be charged in the current year. So 22,500 will be recorded as an expense as well as a liability. So we will record it in the income statement as 22,500. We will also record it as a tax liability. $2,250 because the tax will be paid next year. Inventories held at 31st of December 2008 are valued at 68,000. Within this inventory, there was 1,000 units of the finished goods valued at £20 each. These units are Now expected to sell at a discounted price of £18 and incur £1 selling cost. So we need to remove the value of this inventory which is at £20 because that has the value of that inventory has been decreased. So if you remember, IS2 says that International Accounting Standard 2 says that take the cost and the recoverable amount. Take the lower of. Over here we need to take higher of. Fair value less cost to sell, and value in use. So this is fair value is 18 minus 1 cost to sell, because if I want to sell it for £18 I need to incur £1 as an expense. So that is 17 and that is 20. So what I can do is I can ignore this one. I'll keep the calculation simple, and the cost, original cost of the total inventory is 68,000. I will remove the value of the inventory that has been outdated or whose value has been dropped, which is 1000 into 20. 20,000. So remove the value and add the lower value, which is 1000 into 17. And that 17 is, as I explained earlier, 18 minus 1. And that is £17,000. And that will give me £65,000. So £65,000 is the value of the inventory. So you can see from 68 it has gone down to 65. So let's record it. Remember, this is a closing inventory. And the value of the closing inventory will be recorded in the income statement, 65,000. And this will also be recorded in the current assets as £65,000. Next, let's do the calculation. The cost of sales, opening inventory plus purchases plus wages plus the depreciation of plant and machinery, building, and 8,200. 8,200 is for the building, yes. Minus 65,000, and that will give me cost of sales of 96,3351. If I subtract it from the revenue on the top, my gross profit will be 63696. Sorry, 636696. Now let's add our expenses. Administration salaries there, administration expenses. Let's add So I need to add 24,000 plus 6,700 plus 8,500. 24824 plus 6700 plus 8,500. 40024. So what I can do is I can erase this figure and write 40024, and the administration expense, which was 24,000, I'm just going to record it over here, 24,824. Distribution expenses are 33,891. So the total expenses, this plus this plus this, is 200,147. We need to subtract them from the gross profit plus the royalty income. The answer will be 475594. The interest expense. So let's record the interest expense. Notice that we have a loan. The loan amount is 62,600, and the interest is 10% on it. So let's subtract that. 62,600 multiplied by 10% is 6260. And the profit for the year will be 446,834. This profit for the year should become part of the retained earnings. So let's go to the workings over here. We will add closing balance, profits for the year, 446,834. Let's find out what is the closing balance. The credit side is heavier, 76,015 plus 446,834. So the total is 522,849. 522,849 minus the payments for the dividend, ordinary dividend, and the preference dividend. And the carried down balance is 5,078,49. Brought down balance. This balance will be recorded in the retained earnings. Working number 1, 507,849. The total of liabilities, and remember that this liability of preference dividend will be paid in the next year, as it was written in the notes. The dividend has been declared, but it will be paid in January 2009. That means we need to record 2,500 as a liability. Preference dividend payable, 2,500. Now adding these three together, the total is 48,000. Now adding the ordinary share capital, preference share, retained earnings, current liabilities, and non-current liabilities, the total is 768,449. Now intangible assets are 12,000, 36 to 300, 55 800, and the total of these three is 430,100. The total of current liabilities is 338,349, and now adding the non-current assets and the current assets, the total is 768,449. So now you can see that the total of non-current assets and the current assets is 768,449, whereas the equity plus liabilities is also 768,449. So this is the full calculation of Papaya Limited. I hope you will find this video useful.